And we are back. We are so back. Stocks rallying, defensives getting sold, tariffs on pause, and it looks like negotiations are happening in the White House. So the question on everyone's mind, is this the low? And do we take out all-time highs from here? That is a question I will ask and answer today. I will give you my exact S&P 500 game plan for the next month and for the rest of 2026 and give you the definitive answers of, is this the low and do we take out all-time highs? However, when we pivot to policy, there's a saying in the investing world that stocks are not the economy. Trump has taken the path of austerity, gutting the IRS and Veteran Affairs offices, looking to cut almost 50% of jobs in those departments. ADP private payroll numbers today were terrible, and while stocks don't follow the economy, a weak economy is good for nobody. So is this the end of the great American economy? We're going to talk about that and some of the most concerning charts in today's video. So we've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks rallied on Wednesday as President Trump provided a 1-month exemption on auto tariffs on Mexico and Canada, and US manufacturing data came in better than expected. Guys, there was just green across the board. It's probably better if we just talk about what wasn't green, and it was mostly defensive sectors as well as energy. Energy was deep in the red today. Again, that's because energy prices, oil prices, crude and Brent are falling. We also saw utilities were down, again, a proxy of energy and also a defensive sector. We saw some mixed price action here in consumer staples, and we also saw communications, another defensive sector, sort of flat to red here today. And then a consumer staple stock in the tech sector, Apple, was also flat today, underperforming the broader tech market, which was very green. Nvidia was up 1%, AVGO was up 2%, hardware as a whole was up in a very big way. Same with software and infrastructure. Microsoft and Google were up 1.23%, Microsoft up 3%, Meta up 2.5%, Oracle up 2.6%. Financials caught a break today as well. They were all green except for Bank of America. Amazon, Walmart, Costco, these quintessential sort of like growth staple stocks, excluding Amazon, that's in a different league. They were very green as well. Commercial services were green. Tesla was up 2.60%. Manufacturing was up. Everything was really green today. However, that is coming off the last week or so, 2 weeks of trade, which have been very ugly, very red. So, but definite buying, definite money flowing into cyclicals and growth assets today. And we saw that. Look at the best performing sectors: XLB, XLI, XLY, right? Discretionary, industrials, materials, technology, communication services. These were all up in excess of 1%, with XLB, the material sector, up 2.71%. And again, this is somewhat a play on China. We do know that China is about to implement some pretty big stimulus measures. And again, that's one way to play Chinese stocks if you don't want to own the tech names and if you don't want direct access to China as a whole. But we saw the S&P 500 was up 1.14%. XLU, XLP, they were the worst performing sectors today. And then gold was up 0.21%. So we definitely saw some more risk on sentiment enter the market. And then we had energy, and we'll talk about why energy is falling, energy stocks specifically. But all in all, I mean, even stuff like healthcare, even stuff like real estate was still up in excess of 1% today. Very bullish day. However, we sort of only saw the bullishness occur after midday. We were actually, a number of sectors were actually red coming into the midday area, and then we saw a little bit of bullish price momentum to cap the day off. It was bullish everywhere, small caps, mid caps, as well as large caps. And what we really saw was large cap growth was the best performing factor here today. But really, it was growth as a whole, mid-cap growth, small-cap growth. And what we really saw was just a stair-step in performance. Value did very well, but they were outperformed by core, which was outperformed by growth. So, and what we really saw today was a risk-on trade in US stocks across the board. If you were indexed to small caps or mid caps or large caps, your portfolio is likely very green today. And we saw the same type of price action globally. Canada was green, although less than the US. We saw South America was fairly green. Same here with Mexico. Europe was very green. And that has to go with a lot of the stimulus or quasi-stimulus we're getting from places like Germany. They're bolstering up their defense. Germany is about to implement a $500 billion package to boost their defense sector. And I think much of Europe is going to follow the same. And that is why we saw European equities very green, along with the fact that valuations are very low. They look attractive, and this money eventually makes its way into the equity markets, into the financial markets, and that is why we're seeing a lot of the front running of this stimulus. China was also very green today, and most of Asia, India, Southeast Asia. The only place that wasn't really green today was just Australia and New Zealand. And again, this has to do with time differences. Australia will be very green today because of what we saw here in the US markets. Now, let's actually talk about some of the things that made the market move today. Was the White House came out and announced tariff exemptions for US automakers. Now, Donald Trump has agreed to a request from 3 Detroit manufacturers, so this is Ford, GM, and Stellantis, on exemptions for vehicles crossing the US border with Mexico and Canada. This is going to be on for 1 month, and then I believe auto tariffs of 20 to 25%, or 10%, I'm not too sure, they're still ironing out the details, will come into place. So this is just so that these automakers just have another month to bolster their supply. So that actually might impact the import side of GDP even further. So we may see the GDP now figure further deteriorate, because we do know that imports subtract from GDP, and a lot of these manufacturers may be on the run to import as many cars to avoid those tariffs in the next month. Now, Donald Trump did actually get on a phone call with Justin Trudeau. They were probably speaking about tariffs. He let this tweet. It sort of seems like a mocking tone. I don't really know. Maybe I'm reading too much into it. It does look like Canada and US tariffs are still going to be at that 20 to 25% range, excluding the 10% exemptions for stuff like steel and I believe lumber as well. So, guys, we are seeing a movement in tariffs. This does look like it is a negotiation tool, and maybe we can come to an agreement by the end of this week, maybe start of next week, over the weekend, to see what tariffs are actually going to be like. I hope we do come to an agreement. That would be very good for the market. There was a couple of other things that really I thought moved the market that was important. The Trump administration plans to cut 80,000 employees from the Veteran Affairs Department, and I believe these are going to be non-essential employees. And this is just to curb the expansion that the Veteran Affairs saw under Joe Biden's administration. On top of that, the Trump administration is looking to halve the size of the IRS. Again, non-essential workers, and looking to cut potentially as much as 90,000 individuals. That would be 50% of the workforce. So we're seeing, I guess you could say, some form of austerity here in the Trump administration, really cutting the size of the government, hoping that these employees will find work in the private sector. And what Donald Trump is really hoping for is growth in the private economy, as well as higher productivity. Now, there were a couple of other market movers as well, but it didn't actually impact the market as a whole. ADP employment actually missed in a very big way. This is private employment. The consensus here was for 140,000. The actual reported figure was 77,000. So a big miss in private payrolls. That doesn't bode well for NFP. However, composite PMIs, US manufacturing on the composite side, as well as services side, as well as the ISM PMIs, all beat expectations. And in fact, if you actually look here at global services, we were expecting good traction. We saw an expansion at 51. Very, very interesting. Factory orders beat expectations as well. And the 30-year mortgage rate actually fell from the previous level last week. That's very interesting. Those are the things that really moved the market. I guess the market viewed all of this as positive, also coming from a deep trough in sentiment. That is why stocks rallied. But what also helped stocks move today was Foot Locker. Foot Locker was up 4.3%. The footwear giant delivered mixed results for its holiday quarter. It reported its fourth quarter earnings. It beat Wall Street's expectations on earnings, but fell short on revenue. In the year ahead, it anticipates that the trend will reverse for fiscal 2025, so we should see growth. However, Foot Locker is still expecting profits to be lower than Wall Street estimated, although the high end of its comparable sales guidance was better than analysts' forecasts, and that is why we saw upbeat momentum in this name. Its largest brand partner, Nike, is still issuing discounts to clear out stale inventory, which is impacting Foot Locker's performance, and Foot Locker said Wednesday it expects another year of deep discounts in the sneaker industry as its largest brand partner, Nike, continues its reset and relies on markdowns. But essentially, what this earnings report told us is that we are nearing the end of this inventory cycle, and somewhere in 2025, all of that stale inventory will be gone, and then we could get back to business as usual. And that is why we're seeing a little bit of upbeat momentum here in Foot Locker. ANF Abercrombie Fitch was down 10.47%. Now, this stock has seen blockbuster growth up like 500% in the last 2 years. However, growth is slowing, and that is why the stock pulled back 10%. The company's forecasting fiscal 2025 sales to rise between 3 and 5%, falling short of expectations of 6.8% according to LSEG. However, during the holiday quarter, they did actually beat on both the top line and bottom lines ever so slightly. So the market not liking the guidance figure here for Abercrombie Fitch. And by the way, the stock is still relatively cheap if you ask me. And today we saw 4,200 advances, 2,000 decliners. We saw inflows in both the NASDAQ and the New York Stock Exchange to cap the day where it was. However, we could not retake any of the moving averages. We saw the shorter term, medium term, and longer term moving averages still below the 50% mark. However, we saw dramatic improvement in all of them. Look at yesterday, 17% to today's 40%. And then we also saw the same here in the longer term moving averages and the medium term moving averages. This is the type of stuff you want to see at market lows. Now, looking at equities as a whole, the S&P 500 up 1.12%, the NASDAQ 100 up 1.36% as well. We saw upbeat momentum in small caps, mid caps, profitable small caps, the equal weight S&P 500, and we're seeing very mixed price action here in the after hours, with the Qs down 0.26%, and we saw a continuation of what we saw yesterday in yields. Yields did rise ever so slightly, and the dollar continuing to fall. We're going to talk about the dollar breaking some very key levels in the chart segment here today. Bonds as a whole, the AGG and TLT was down 0.8%, and also looking a little bit red here in the after hours. That's obviously as a result for yields moving higher. For those of you that don't know, yields and bonds have a negative correlation. If bond yields go up, bond prices fall, and that is why we've seen bonds be a bit of a dumpster fire in the last couple of years, because yields have risen in a very significant way. Gold was up marginally, silver up 2%, WTI fell. That is why we saw energy stocks fall, but Natgas was up 3%, and then we had Nvidia up 1% for the day. Now, looking at the S&P 500, there were no changes in the gamma levels. However, what we did see was that the puts to port right here did move up ever so slightly, but it was marginal, absolutely marginal. It wasn't anything to write home about, and we are still in negative gamma. Now, I did say yesterday that the key for this market, especially for the S&P 500, would be if we go ahead and actually retake the gamma flip. I said this would also act as a strong resistance zone. We did go ahead and retake the gamma flip again, but bears were emboldened as well. You can see they did come in. There is a bit of a wick here, very similar to yesterday's candle. However, the bulls definitely in the driver's seat for now. We're at a critical level. The bulls need to retake the gamma flip zone and make their way higher. If not, and the bears find resistance, I do think that we do target the bottom end of the range. We are in negative gamma, so we are still targeting this lower end unless we go ahead and actually retake the gamma flip zone. It's a very binary trade. Above the gamma flip, we're aiming for this. Below, we're aiming for that. And we're at this line in the sand right now. So guys, instead of trying to predict what's going to happen, wait for confirmation, wait for consolidation, and then pick your poison, take your shorts, take your long. If you're a long-time investor, you should really be, adding at these levels. Generally speaking, a great rule of thumb is every 5% pullback you want to add. So at a 5% pullback, 10% pullback, 15% pullback, you guys just want to add capital at those levels, particularly in something like the index. The average drawdown in the S&P 500 is 21%. That means you'll have 4 tranches to get in if we do pull back in a very significant way. And that's just a great rule of thumb that I like to use. Nonetheless, the S&P 500 at a very, very key level. Now, we have made a lower low right here relative to this low. However, a higher low or equal low relative to that. So there is a bit of technical support that we are finding right here. But what I really want to see the S&P 500 do is take out this level right here and then take out some of these levels right here. Until that happens, we continue to be in a daily downtrend as it is right now. And the path of least resistance is lower until we actually go and recapture a key critical level or build like a very strong level of support at these lows at the 5,700 area. The NASDAQ 100 outperformed the S&P 500 today, and we actually are in positive gamma for the NASDAQ 100. It actually didn't get to the low of the put support. However, what we did see is some very constructive price action, very similar to the S&P 500, where we're sort of at the highs of yesterday from from here, what the bulls really need to do is defend the gamma flip. So if the bulls can go ahead and do that, it probably means we do go higher. But let's say we do like pull back tomorrow and we are seeing some negativity here in the after hours and we actually break the gamma flip, that probably means we go lower. And then it's not a long shot off to go ahead and make a lower low to get to the 19,083 level. However, we are in positive gamma, and that means our target right now, the 21,185 level. Looking at the RTY, similar to the S&P 500, we did see the put support move up. Everything else stayed the same. We're at this very key level. Above the gamma flip, we're looking for upside. Below, we're looking for this level right here. But it does look like we actually did put in the low, touch the bottom, and then it is now we're looking for upside. There's some very, very strong buying at these wicks here in the Russell 2000. And the same is true for the NASDAQ 100. Look, this is some very clear buying. And with the NASDAQ 100 push above the positive gamma zone, the gamma flip zone, and the S&P 500, there's some very, very clear bulls taking a stand saying, hey, I like anything below the 5,800 area. Bulls coming in and buying the dip, what we saw today. However, this is going to have to coincide with some positive data. And if we get a bad non-farms print, right, that could derail everything. So right now, I think what the market is going to do is they're going to be in wait and see mode. That ADP print, definitely not a fantastic print. And if we actually go on the 1-day chart, right, you can actually see that when that ADP print came out, it came a little bit before the market opened, right? We actually traded real sideways to slightly lower. It was only after we got Trump's announcements here at midday that we actually started to rally. So that ADP report did weigh on overall market sentiment. So don't discount the fact that, if we just brushed off the ADP numbers, no, there was definitely some underlying trade that we saw. We saw some digestion. We did see a pullback on those numbers. So only after Donald Trump came out and said, hey, I'm speaking with these leaders with regards to tariffs, blah, blah, blah. That's when we actually made the move higher in the S&P 500. Nonetheless, guys, one thing we're also seeing is looking at the 200 moving average. We actually just bounced right off the 200 SMA right here in yesterday's trade. Long-term fund managers and long-term buyers love to buy at the 200 moving average. And if we actually zoom out, looking at the rally off the lows from 2022 right here, the second we sort of like broke above the 200 moving average, we tested it here, went higher. We kind of tested it here, went higher. And then now we're testing it right here, and we'll see if we make the next move higher. The 200 moving average is the golden standard of support. We're finding support right there. Look at today's trade. Look at what we did yesterday. And so this should be an opportunity for you to buy. So take that as you will. And it also really lines up with the put support. Very interesting to see that. Looking at the NASDAQ 100, let's see where the 200 moving average is. Again, right there in the same spot. And then I believe for the RTY, it's actually going to be below it. Yeah. So look, the RTY technically in a downtrend, we did go ahead and break it. But, if you're looking at the major indices, the stuff that's going to really move the market, finding critical support at these levels. Now, let's actually go ahead, talk about the DXY, because I said yesterday that this is going to be a key level that we're going to have to hold. If we break through it, we go lower. And it looks like right now we're going to target the 103 area very, very quickly. This is 3 very deep, very bearish candles. Like what we're seeing is literally a move out from the dollar, people selling the dollar, looking at stuff like the euro and other currencies. We actually broke the 200 moving average as well. This is the next level of support. I expect find very, very strong support right here, but that does mean we can actually move a lot lower for the dollar. This is very good. This is very, very good for equities as a whole. This is part of the reason why we actually saw large caps outperform the broader market. We actually saw the dollar fall, and that is the 3rd day in a row. And this is literally a higher low. It's exactly what I said at the start of the week. I said we're going to make a higher low right here, and look at where we are right now. From 107 to 104, that's a deep pullback in the dollar. And do expect more of the same until we hit the 103 area. It does look like equities are trying to put in a bottom, but what I really want to see is consolidation at these levels first, and then make a next move higher, because we could definitely go lower. Now, guys, looking longer term at the S&P 500, what I believe is going to happen is I think we're going to see a move that's going to be very volatile to about the 6,000 area. I think we're going to see another pullback to about the 5,500 area. and I think we're going to see another move up to the 6,600 area, potentially as high as 7,000. Then we can think about a deep pullback in the S&P 500 that might even break the 5,500 level and lower. But in the year and now, in the medium term, I think we do go higher, and you do actually want to stay invested in this market because the equity market is showing exceptional strength nonetheless. But that is my longer term target, and it's all subject to change. I reserve the right to change it at any single moment. Guys, Green Day, take it as it comes. Let's see if we can keep up this momentum. If we can, that should bode well for the markets as a whole, but it's all going to be dependent on the non-farms print on Friday. I think the market is right now in wait and see mode. Now let's actually talk about the S&P 500's return drivers for this year. So this chart is about 1 day out of date. You can see it has the S&P 500 as positive returns. That is not entirely correct. The S&P 500 year to date is actually returned about negative 1.5%. However, the earnings growth is still at about 1.3%, which means we've actually seen a multiple contraction here in the S&P 500 of about negative 2.8%. That is incredibly healthy, especially considering the fact that Q4 earnings came in at 17% growth, and when you exclude energy, 21% growth in that quarter. So this pullback we are seeing, if you are a very long-term investor, you want to go ahead and buy the dip, especially because earnings are growing, and ultimately earnings drives the S&P 500 will eventually re-rate if that earnings continues. And that is a huge if, because tariffs simply do impact stocks by affecting EPS. S&P 500 earnings per share for calendar year 2025 is expected to be $268 per share. You can see that a 25% tariff in Mexico and Canada, and then a 10% tariff on China should affect stocks anywhere from $15 to $17 in earnings per share. So that could be a 5 to 7% impact in earnings for this calendar year. And if we actually see retaliation and reciprocal tariffs, this number could jump to 20, 25, 30%. I don't know where the bottom is, but that is why the market is doing what it is right now. And that is why sentiment is in extreme fear. It simply has to do with the uncertainty. Markets will climb the wall of worry, but they will sell off on uncertainty. Now, I do think we are probably going to range trade in this area for quite a while. We do know that there are more government cuts coming. The IRS is looking to gut about 90,000 workers, about half of its total workforce. And I think this is going to keep the uncertainty brewing in the market. But the second, guys, we get certainty in the market, the second some certainty comes about, expect this to re-rate in a very big way, particularly because looking at Q4 earnings, things looking very, very robust, all things considered. And then when we look at seasonality, on a technical standpoint, what we should actually see from about this time of year, right, is actually like a bottom formed in the S&P 500 and then a move higher, making higher highs, higher lows into the end of the year. So from a seasonality perspective, what we've actually done for most of the year is actually kind of normal. It just depends, can we actually get that certainty for us to go ahead and move higher into the end of the year? My inclination is that in the very short term, we're probably not going to get that certainty, and we might not even get that certainty for most of 2025. Seasonality is not a crystal ball. It just allows us to assess probabilities, and the probabilities based on previous cycles is that we normally do go higher in a post-election year. However, anything can happen with this administration. However, one thing we do need to pay attention to is the macro, because policies are changing quickly, and changing policies come with costs. Layoffs in government jobs push unemployment up, while tariffs raise prices and cut demand for foreign goods. How big is the hit? According to Apollo Research, it depends on the scale and length of these policies. Their charts model that the Fed's FRBUS showed tariffs and DOGE will bump inflation up 0.2% and shave GDP by 0.5 percentage point over the next few quarters. A mild but temporary shock. CapEx plans are stalling, consumer confidence is dipping, and jobless claims are climbing, partly from government workers filing unemployment early. The bottom line, we should see modest stagflation, not a recession. This is all according to Apollo Research. So, when we actually see economic growth stall, unemployment tick up, the consumer getting a little bit more concerned, that is a mildly stagflationary environment. However, Apollo don't see a recession in the near term. And again, all of this is short-term temporary weakness for major comeback. The market is officially pricing in 3 rate cuts now pretty much from zero at the start of January. We're now looking at about 3 cuts and potentially the first cut in June. We do have the FOMC in a couple of weeks, and there is about a 3% possibility that we get a rate cut in that meeting. Will we? I don't know, but the Fed is definitely aware that the economic picture is weakening ever so slightly. However, the bond market doesn't seem too concerned with this weakening. This is a yield spread between AAB corporate bonds, right, and treasury bonds. So yield spreads, yes, are rising, but they're not blowing out like they did here in 2022 or like they did in 2020. And the market not really demanding a whole lot more for taking on the additional risk that comes with the BBB corporate bond, telling us that the market is not concerned with the solvency of these corporations. And that is a really good thing long term. I would be worried if this blew out like it did in previous episodes. That is simply not the case. And we also do need to go off what the market is telling us. A lot of conflicting signals, but we're cutting through the noise. And yes, we should be concerned. However, rate cuts are on the table. This is a business-friendly administration looking long-term, and the bond market's not telling us to be concerned just yet. Looking at earnings and data tomorrow. So before the open, we had JD, Cracker Barrel, Kroger. That's about it. Macy's as well. So a couple of big names. And then after the close, the big one is going to be Broadcom as well as Costco. We do have Gap Inc. reporting their earnings as well. Hewlett-Packard reported their earnings early, so we know what they're going to do, but they're reporting earnings. And then Samsara as well. So a pretty big day tomorrow. And we've had some pretty big days of earnings this week. Very, very volatile from Target to CrowdStrike and now tomorrow with Broadcom. And then looking at data tomorrow, guys. So we have the balance of trade that's coming in the morning, the exports and imports. I think the market is really going to watch this, especially because when you look at the GDP now figures, the reason why we saw that massive drop is simply because imports came in a very big way that actually subtracts from GDP. The forecast here is for 273 billion in exports, 396 billion in imports. Imports subtract from GDP, but we also want to look at the inventory numbers as well. We also get initial jobless claims. That's another read-through for the non-farms print we get on Friday. And then we also have Waller and Bostic with their speeches as well. So some pretty big numbers. I think we're going to pay a particular attention to the export and import numbers. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.